So you're right in terms that oil prices will remain both volatile and low. And you're right in terms of the fact that it seems that the equity market is responding to oil. But there's something much deeper going on, Maria. Both oil and equities are responding to three big changes. One is a weaker global economy, depresses corporate earnings, depresses the demand for oil. Secondly, both markets have lost their stabilizer. Central banks are no longer unified in supporting the equity market, and OPEC no longer plays a role of swing producer. And thirdly, capital has become very anxious, so people aren't rushing in to stabilize. So I think of this more in terms of these markets are responding to common factors. Ironically, over the long term, low oil prices is good for most of the members of the stock market because it means more money in the pocket of consumers.
But it's reacting to a different thing, and that's the global economy. Do you think we'll go into a recession in the U.S. in this year?
I don't think this year. I put the chances for next year at about 30%. 70% we don't, 30% we do. The irony is that we've never achieved liftoff. We never got to what this economy is capable of, and that's a tragedy.
Yeah, Mohammed, I think you bring up a great point. We never actually achieved that liftoff because I'm looking from 2012 to 2014. We saw the S&P 500 go up 72%. 56% of that came from multiple expansion, right, which is pretty significant. That lends credence to the Federal Reserve leading to people actually going into riskier assets, right? I mean, and the three drivers of the markets are earnings, PE multiples, and dividends. So what do you think is going to drive this market going over the next year and the next 2 years? Is it the dividend payers? Do we look at that? Or do we avoid those high PE companies?
So the key issue is for fundamentals to validate asset prices. You're absolutely right. What we've had is a decoupling, and we've had it for good reasons. The Federal Reserve has pushed people to take more risk. By lowering interest rates so low, they've literally pushed people into risk assets. And that has decoupled, and the hope had been that as we all open up our 401k, we feel richer and we go out and spend. That hasn't happened. So critical now is that fundamentals validate. In terms of specific companies, you really want to look at balance sheets. You want to bet on companies that have balance sheets that allow them to do two things. One, have the resilience to deal with a possible economic downturn, and second, the agility to pounce, as companies tend to do when opportunities arise. So I think balance sheet is the most important thing to look at.
So did the only game in town, the central banks, about which you've written a book, did their efforts fail post-2008, or would it have been a lot worse without the sort of intervention that we saw?
So I think of it in three ways. 2008 to 2010 gave them an A. They stepped in, they normalized markets, and we averted a global depression. In 2010, they pivoted to taking responsibility for much bigger economic issues.
Yeah, you're right.
Absolutely. They did well in buying time for the politicians to step up to the plate. They kept the game going.
Nobody stepped up.
Yeah. But nobody stepped up. So now we're dealing with the collateral damage of having interfered in markets for so long. Remember, Ben Bernanke said in August 2010, when you go unconventional, it's about benefits, costs, and risks. Now we're seeing the costs and risks.
Why are policymakers so afraid of a recession or a downturn? It's a natural part of a business cycle. Why are they scared of this? Because the more they delay it, the worse it's going to be.
Because the policy car has no spare tires. We've used all our spare tires.
There's nothing left.
There's nothing left.
Can the Fed continue to, be on the light side in terms of, not doing any more QE while the rest of the world is actually in stimulus mode, where you got Japan and Europe actually cutting rates and can that happen?
And that's a great point. That is what's new now, is divergence. Is central banks are going in different directions. The Fed is easing its foot off the accelerator. 4 other central banks are pressing harder. And that's a very confusing world, not just for investors. That's why we're getting volatility. But even the successful countries are having difficulty navigating a world. We have a system built on the notion that the center, the core, the advanced economies are responsible. But if it turns out that acting irresponsibly is responsible in the advanced world, good luck if you're in the periphery.
You were right about this. About a year ago, you came on the Sunday show and you said, no, I would be a seller in this market. It's way too nervous and way too cautious. Are you still in that position? Do you think we're going to have the whole year as tough as we saw at the beginning of the year in terms of equities?
So I think we're going to have volatility, and we have to get used to that. We're exiting a period of unusually low volatility, and we're entering a period of higher volatility. That is going to actually create a lot of interesting conditions, because when markets get very volatile, you get contagion. Good names get trashed as much as bad names do. So I think this year is going to be a great year for those who can pick the right stocks, and there are going to be lots of opportunities. I still think you need cash. You need 25 to 30% cash right now.
Wow, that's a big cash level.
It is. It is, but starting from the, valuations have been decoupled, so be
That's just
careful.
the U.S. Should we look at the ECB and what's happening in Europe, and should we be going over to Europe?
I worry a little bit about Europe because they are even further behind in the economic healing process. I think if you want to pick up value and you really have the stomach for volatility, some emerging economies have sold off to ridiculous levels. They've been trashed by bad technicals. So, if you can stomach the volatility, the most value right now is in some emerging markets. But be selective. Don't do it through an ETF, because when you buy an ETF, you're going to end up buying bad names as well.
Everything. It's like a basket of them.